Hello, everybody. Welcome to Macro Money. This is Ilya Spivak, head of global macro here at tastylive. Welcome to the show. Today, we are faced with a really interesting market environment. We have what appears to be sympathy Fed repricing across markets. The Reserve Bank of Australia hikes, surprises markets. Reserve Bank of Canada hikes, surprises markets, and the markets walk away with saying, well, so what's the Fed going to do about this next week? But we're going to take a little bit of a pivot to look at another not Fed central bank, where this story continues to be evolving and where we have one of the more interesting dichotomies in this environment. We're going to look at the euro and look at the very unique issue that it finds itself, even as these inflation dynamics and interest rate dynamics evolve to perhaps suggest that central banks haven't done enough. But we're going to look at how the euro ended up being weak all through May, look at some key levels that it's now approaching that may be trend defining, and then look at how it got there and where it's likely to go next based on what the ECB might do just in the wake of the Fed next week. So let's begin by looking first and foremost at the setup as it presents itself in the price action. So this is the 6E future here. You can see that the vertical line there marks May the 4th. That's after the Fed policy announcement, which occurred on May the 3rd, and the ECB policy announcement that occurred on May the 4th. So everything after the last time that we heard from both central banks has looked like a very orderly euro decline. And we're now coming in to what is the range support since the beginning of the year, around 105.29. That's the major sort of shelf that the euro has held to since the beginning of the year. And of course, the question now that we're sort of within the gravitational pull of that level, are we going to break or are we going to bounce? The last time we hit this level, of course, we had significant increases, both at the beginning of the year and then again when we started to move on this in March. And so the question now, what's actually driving this? And is it the ECB? Well, the ECB finds itself in a little bit of a difficult position. Consider, in the yellow bars is Eurozone CPI. It's been lagged here by 6 months to line it up with market expectations of inflation, which tend to lead it by about a half year. The market expectations we have here are a little bit longer term than what we typically look at for the U.S. There we like to look at the 1 year swap or the 2 year swap or the 2 year break even. We don't have liquid instruments that are at the shorter end of the maturity spectrum like that for the Eurozone. As a little aside, if you're wondering why de-dollarization is utter nonsense, it's because we do have those kinds of instruments and then all other kinds of instruments and all kinds of depth of liquidity in U.S. markets that you can't mimic even in incredibly liquid, incredibly developed markets like the Eurozone. That notwithstanding, here we do have a 10-year break-even and a 5-year euro inflation swap. And you can see that they tend to lead realized CPI, as you can see here, by about 6 months. So what we see here is that realized inflation is at 6.1%. These longer-term swaps and the 10-year break-even for Germany pointedly north of the 2% ECB target. Now, because these are longer term values, it's perhaps not unusual. Perhaps the markets are anticipating a pickup in economic growth over that long of a time horizon, and we are in fact going to get inflation down to 2% anchored within a more reasonable 2-year period. Maybe this is term premium in these numbers, essentially nudging them up a little bit above the 2% ECB target because lots can happen in a 10-year period. So there's uncertainty there. Maybe there's a bit of a term premium there then. But the larger issue is the trend. We can see here is in recent months, the trend in inflation expectations has been going the wrong way. We started to see disinflation here in line with what these expectations were expecting. So you can see here 6 months ahead of where CPI started to turn. Remember, it's 6 months lagged. We started to get the come down in the break even. We started to get the come down in the 5-year inflation swap. You can see that you're starting to get that response 6 months later from CPI, and it's been coming down off the highs near 11 down to 6.1. But expectations are now trending the wrong way. And so for the ECB, this is, of course, an issue. They need to get inflation back down to 2%. And so what they need, ostensibly, is to counter these dynamics with rate hikes. That might put them in sympathy with what we just saw from the RBA and the Bank of Canada, as we just mentioned at the top of the show. And indeed, if we look at what is actually priced into expectations, here go the rate hikes. So you can see for June, that's next week, 93% probability of a 25 basis point hike already priced in, 23 basis points of the 25 already in the market. There goes the 23 basis points top of the implied rate delta column. So you can see it right there. By the time you get to July, notice the number hikes cuts column has 1.72 in it. What that means is that one hike is already there at that point, and there is a 72% probability of a further hike. So you can see in the implied rate delta column now 0.43. So 43 out of 50 basis points baked in by then. Look at September, 2.1. So by then, both hikes are there, and you can see the implied rate delta is 54 basis points. So the markets have said that come September, we're going to have 2 rate hikes from the ECB. One ostensibly by July, the other by September. It could happen sooner. It looks like June might be where we get the first one. July might be where we get the second, and then stand still in September. But as it stands, somewhere in those 3 meetings, we are going to get 1 hold and 2 hikes, according to current market expectations. Now look down. From October down, in the number hikes cuts column, you never go above 2. In fact, you never even approach a probability of better than even odds on a third hike. So at no point do we get, let's say, to 2.5, which would be 50-50 on a third hike. In fact, we seem to peak in October, and then the numbers start to get smaller. Remember, this is relative to current policy settings. So what it's saying in October is, relative to now, by October, there's been 2 hikes, so 50 basis points, and a 25% chance of a further hike. What you see then is things start to deteriorate. And come April of next year, which is where the current pricing runs out, you've already had essentially 1 cut. You can see that cut really start to show up in March. By April, it looks all but certain. So the message here is the ECB has an inflation issue. Inflation expectations seem to be going the wrong way. What they're going to do, according to market expectation, is deliver 50 basis points more in hikes over the course of the next 3 months. Seems straightforward until it isn't. If you look at the yield curve, as it's developed over the past month, again, we're looking here since the last ECB meeting, that was on the 4th, and since last week, there's been no movement here. The current yield curve is effectively unchanged. It's moved around a little bit around the edges past the 6-month mark, but in that very critical period here where we're going to get rate hikes in the next 3 months, curve hasn't changed at all. It's become a little bit more hawkish relative to last week if you squint really, really hard, and perhaps a little bit more hawkish a month out if you, again, squint really, really hard. But since the last ECB meeting, there have been no real changes here, which suggests that all the rate hikes that we have here have been priced in and are not a reason for the euro to go up. And this hasn't been a reason for the euro to go up for the better part of the past month, which of course would be quite consistent with what the euro has been doing in the past month, going down. Now, why is it that given what we see in inflation expectations, why is it that the markets haven't bid up rate hike expectations for the ECB? Why is it that the euro is falling when what inflation expectations suggest is that the ECB has more work to do, that they're going to need to do it, that the 50 basis points priced in now aren't enough because clearly they've been priced in for at least a month, and that hasn't stopped inflation expectations from building. Again, let's take a look once again here, and in particular focus on the red and the blue line. Both are on the incline. So what we're looking at here is clearly 50 basis points that have been baked in for at least a month already, because the yield curve isn't really moving in that period of time. Inflation expectations are going up in that time, but the market doesn't think the ECB is prepared to do anything more about it than what's already there. That's an interesting disconnect. Let's find out why. The natural sort of thing to want to look at in this kind of environment becomes, well, is it maybe something having to do with sovereign risk, the sort of perpetual boogeyman in the Eurozone? And the answer seems to be probably not. What's really interesting here in looking at the way that ECB tightening has worked out is that we seem to have a situation here where we have a fairly benign tightening. So if we look at what the market is giving us at the moment, we have the tightest policy conditions that we've had in the Eurozone since the financial crisis of the 08-09 period, which is, of course, as eye-catching as it should be. The ECB is not exactly taking this inflation situation lying down. And, of course, it's getting some help. It's not the only central bank tightening. But what you see as this tightening is occurring, the dark line there, of course, the financial conditions index in the Eurozone, that's courtesy of Bloomberg. What you see is the orange line, the spread between Italian and German 10-year yields moving lower, and overall financial stress, that's the Global Financial Stress Index from the Office of Financial Research, an agency within the U.S. Treasury Department, that's been going down. So the market is effectively saying, overall, the ECB is not engineering any kind of stress from a sovereign perspective, and neither is global tightening writ large. Now, let's unpack this just a bit. Why are we looking at the Italian-German 10-year spread? Well, in the wake of the Eurozone debt crisis back in 2010, 2011 when it really got underway after the initial sort of U.S.-led housing-oriented crisis in let's call it 06, 07, 08. Really, the crescendo being in the second half of 08 and going into the beginning of 09. If we look at what's going on there, what we see is you have these economies in the Eurozone that are sort of models of fiscal rectitude. Germany is not only the largest economy in the region, but also the most sort of fiscally, well, let's call it sound or fiscally conservative. And then you have your Southern European economies that clearly had a debt accumulation issue. And some of them cleaned them up and others didn't with equivalent vigor. The largest of the ones that had an issue, certainly Greece was something of a poster child, but the largest and scariest, and indeed the third largest economy in the Eurozone, is Italy. So oftentimes when we look at whether this crisis might recur, what we look at is the spread between German, which is sort of fiscal responsibility benchmark yield, and the yield on Italian debt, because in Italy, you largely haven't really resolved the issue. You've kind of papered over it, but Italy remains deeply debt-laden. And financing that debt at higher interest rates becomes increasingly costly and starts to, again, raise questions about, are you going to have a major member of the currency bloc potentially run default risk? And if you were to have a serious default in a member state, or at least if you were to start to flirt with the possibility that you have a serious credit concern in one of the major economies in the Eurozone, because those economies can't stomach higher financing costs courtesy of the ECB's inflation fight, what you should see is that risk get expressed as a growing spread between debt in Germany and debt in, let's say, the benchmark for the southern debt troubled economies, Italy. Because what should happen there then is markets should say, oh, well, clearly, despite the fact that these countries operate with a single currency and a single central bank, there is a greater risk in lending to Italy than there is in lending to Germany, because there's more debt in Italy, in simple terms, that could go wrong, as opposed to the alternative. And as rates rise, you might expect that you would get a situation where you have a more difficult time financing that debt. So markets should ascribe a greater premium to Italy because they should demand greater yields to accept the rising risk of lending to Italy as relative to Germany. Notice, as you got the Fed really starting to talk about raising rates, and of course they led the ECB on this, the ECB caught up later, as you start to get the Fed talking about raising rates toward the middle of 2021, and as that process actually gets underway, so notice, this right here is where the Fed starts to say inflation isn't a transitory thing or as transitory of a thing as we thought. We're going to need to raise rates. This is where those rate hikes actually begin. And this is what has happened since, up until we get into, let's call it October, November of last year, where you'll notice stocks turned higher, dollar turned lower, gold turned higher, all of which to signal that perhaps the markets have seen where the Fed is likely to end their tightening cycle. Look at what happens to Eurozone financial conditions over the same sort of time frame. They begin to deteriorate, they begin to get tighter right as the Fed starts to move. Not surprisingly, that starts to tighten up, and give us a more difficult credit situation in the Eurozone. We've talked about this before. It's because the Fed is the steward of the global reserve currency. So when it raises rates, it increases the cost of borrowing on everyone that uses that currency. Because what the Fed is doing is increasing the cost of borrowing dollars. And because the dollar is the global commercial unit of exchange, and there aren't really no competitors to speak of, what that does is increase the cost of financing on global economic activity writ large, everywhere, not just in the US. So what you see is as the Fed moves, financial conditions in the Eurozone tighten, the spread between Italian and German bond yields starts to spread out. As you get the end of the rate hike cycle become visible to markets, financial conditions start to bottom, and global financial stress markers start to come off. That's the catch-all financial stress index and the Italian-German yield spread at the same time. You can see that here. All this to say, if the ECB wanted to raise rates, they don't necessarily run the risk of upsetting the apple cart here, because despite the tightest policy settings since the Great Recession, sovereign risk isn't really spooked. Broader credit stress isn't really being touched off. In fact, even the SVB episode back in February, which is right here, gave us a bit of a pop, but ultimately didn't really dislodge this sort of sense of calm in markets around this tightening. So it's not domestic reasons, at least from a credit perspective, why the ECB isn't moving forward to raise rates, though ostensibly it needs to, looking at inflation expectations. Instead, it seems to be the worst of all possible worlds, stagflationary dynamics. Here is the Citi Economic Surprise Index for the Eurozone, and we can see Eurozone economic data has been performing abysmally relative to baseline expectations. These are the expectations that are collated by the likes of Bloomberg, Reuters, you name it, sort of the big data aggregators that poll market economists and market watchers for their expectations on a given piece of economic data, compile it all, get you a median. And so when you go out there and say, oh, XYZ piece of data performed better or worse than expected, well, that expectation is that median. Whatever comes out of surveying a large group of market economists and market watchers more generally, and having their collective wisdom give you a sort of baseline expectation for what's going to occur. What Citi does is it takes those expectations and tracks how realized results register against those expectations, then scale it by volatility. So the index moves more up or down if the data surprise actually gets a response from markets. And what you can see here is certainly an eye-catching chart. Since topping back at the beginning of this year, Eurozone economic data in relative terms compared with expectations have fallen off a cliff. So what you see here really is economists' models being woefully incorrect about where the economy is going, and the economy aggressively underperforming what economic models are suggesting. So the economy in the Eurozone, against the backdrop of this tightening, is weakening in a hurry. And what you see in looking at inflation expectations is they're still tracking higher. This is, of course, a tremendously difficult sort of a trap for the ECB to get out of. consider why growth is so weak. Of course, we know that the largest economy in the Eurozone is Germany. It's a nice case in point. It's only been eclipsed as the world's largest exporter by China relatively recently, which should tell you something about how dependent on global demand this entire situation in the Eurozone really is. It's very exposed to external demand dynamics. And you can see it in the PMIs here. There's been a trend very much lower in these PMIs, really since the hump of the post-COVID catch-up. That's somewhere toward the beginning of 2021. You can see there's that hump right there. This is where we get aggressive catch-up growth really across most of the major economies. China is, of course, a notable exception. They only decided to scrap lockdowns in December of last year. And boy, has it cost them. If you want to see the extent to which China's economy has been hobbled and remains hobbled, check out the video of yesterday's Macro Money episode where we dissected what's going on there. But you can see since that hump, growth in the Eurozone has been slowing across sectors. There's been a little bit of a bump last year in services, and that's helped to pull the composite index up, but it's continued to trend lower broadly and appears to have rolled over already. It's already starting to weaken again. Manufacturing has been in contraction mode and accelerating into that direction really for the better part of 2 years. And what we see here is, of course, very much a consequence of what central banks are doing on tightening. You can see here, this is a chart we keep going back to. In the orange is the implied rate for the front month of the Fed funds futures contract. So this is essentially where the Fed is expected to be on any given month. And as that goes up with the tightening cycle, you can see total global trade volumes crest and start to move lower. And they're now, as of the first quarter here, which is as far as this data goes, this is data from the World Bank and the IMF. It's a little bit lagged, but it is at this point the weakest since the beginning of 2021, and that's as of the first quarter of this year. Once we get the second quarter data here filled out, chances are we're going to see more weakness still. So that would explain why manufacturing here is dying on the vine. The PMIs, of course, just to quickly review, come on a system where 50 is neutral, above 50 is growth, below 50 is contraction. The faster the contraction, the lower below 50, the faster the expansion, the higher above 50. So what you see in the services and the composite numbers, they're above 50, they're still growing, but increasingly slower recently. Whereas manufacturing is very much below 50, so it's shrinking and at an accelerating pace, all of which is a function of this global situation. So the ECB finds itself in a very tough spot. Its economy is already in dire straits. It's already looking at significant economic headwinds. Meanwhile, inflation continues to go up. Now, that perhaps is why the ECB is stuck here and why we've not seen a move in the yield curve, despite the ECB's hawkish saber rattling in the rhetoric, to really price in more tightening. In fact, the saving grace here seems to be, because of the Fed's ability to move rates around everywhere, some hope for imported disinflation. What you see here in the green is Fed rates going up. In the red is the Bloomberg Commodity Price Index. So you can see that with the Fed's slowdown of global economic activity, which is that dark blue line, same one as we see here, as that slows down growth, so too we have a slowdown in commodity costs. That, of course, is an important input cost into inflation. So as the Fed raises rates, economic activity slows, commodity prices come down, inflation is reduced. In other words, what the ECB has to look forward to here is that the Fed will do its heavy lifting for it. And even as it saber rattles, it might not actually have a whole lot of room to do this themselves. And that, of course, is a problem for the euro. So consider what has happened with the spread in yield curves and in relative rates between the euro and the dollar over the course of May. So since the last FOMC and ECB meetings, going back to May 3rd, May 4th. This is now the spread in the curves. And you can see that the curve now is much more flat than it was a month ago. So what you see here is Fed policy expectations becoming more hawkish at a time when the ECB outlook, as we've just seen in the Eurozone curve, are standing still. So you can see that we now have an evolving gap, which narrows a little bit over the course of about 2 years or so. It's almost 2% now. It narrows to about 1% within a year, narrows to about 0.5% within 2 years, and roughly stays there. But it tells you a story of, if there is more tightening to do and there's more inflation to contain, the ECB is going to have a hard time doing it, whereas the Fed is seen making moves, at least not to cut in the back half of this year. Hence this shift in policy expectations in the dollar's favor, even as the ECB seemingly looks more hawkish because the Fed maybe is due to get one more hike. The ECB is seen doing more over the coming months. And so with this relative shift in the curve in the dollar's favor, not surprisingly, to go back to the chart we were looking at the top of the show here, the euro has declined. Even as its central bank has been hawkish, even as the evidence on inflation has suggested they should get more hawkish still. And that's something that nicely sets up what we might be in store for next week. If the Fed validates these recent changes in policy expectations, and it does look like with the passage of the debt ceiling debacle, with seemingly containment of the banking crisis for now, we've had this upshift in Fed policy expectations. That has driven the euro lower despite its own hawkish implications in inflation expectations and what the ECB has been saying because of them. If that's the message that the Fed continues to push, if next week the Fed comes out and endorses this shift and perhaps even extends some of that narrative to further confirm that we're going to get a rate hike in July, about an 80% chance of that currently in the market, and then the ECB gives us similar hawkish overtones at its own meeting, the upshot might well be a lower euro. Just as we get into the gravitational pull of this 105.29 level. So it may very well be that what we're setting up for is a tectonic euro breakdown that then shapes the trend for months to come. And that is macro money for today. Thank you very much for joining me. As ever, I am here Monday through Thursday for this show. That's right after overtime with Head of Futures and Forex, Chris Vecchio, here at Tasty Live, where we break down each day's events and try to figure out what the markets did and why they did it. I'm also on with Chris for Futures Power Hour on Fridays, on with Tom and Tony for First Call on Sundays. Outside of those shows, I'm opining on Twitter at Ilya Spivak. Thanks, everybody, for joining. We'll see you tomorrow for the last show of the week. Good luck trading out there. Take care.